Hey, welcome back to Higher Caps. Today I'm diving into how to turn square footage into square profits. Let's get real. The ultimate boss in real estate isn't your bank, it's regional market dynamics. Think of it like a weather forecast for your investments. Ignore it, and you might just end up with an umbrella in the middle of the desert. So, what are regional market dynamics? They're the mix of economic conditions, job growth, population shifts, infrastructure upgrades, and government policies that make a market either sizzle or fizzle. Let's break it down. Economic conditions and jobs. Strong economies mean strong property demand. In 2024, the US GDP grew by 2.5%. Canada's by 1.2%, both beating expectations. Unemployment, US around 4.1%. Canada at 6.1%. That means more people have the cash to buy or rent homes. Population growth matters too. The US added 1.6 million people in 2023. Canada added 1.27 million. Most of them landed in growth hubs like Texas, Florida, Ontario, and British Columbia. More people equals more demand, and often higher prices. Now, infrastructure. New transit lines, airports, or schools. They're basically Botox for a neighborhood. A study found that homes near public transit outperform others by 42% in value growth. Don't forget policies. Tax breaks, zoning changes, or short-term rental bans. These can make or break a market overnight. So how do you use this info? You've got to be a bit of a property detective. Here's your checklist. First, the economic pulse check. Watch GDP growth, local business openings, and job reports. Next, track population. Look for inbound migration. Florida gained over 365,000 people in 2023. California lost 338,000. That totally shifts housing demand. For infrastructure, follow city council announcements like their celebrity gossip. That new subway extension, property goldmine. And always watch for policy changes, property tax rates, rental restrictions, or new incentives. Let's talk case studies. Austin, Texas, classic example. It went from sleepy college town to tech titan. Population jumped 30% from 2010 to 2022. Tech jobs soared, and home prices doubled. But in 2025, things cooled off. Median prices dropped 6.8%. Inventory's up, and higher mortgage rates are slowing buyers down. Lesson? Even the hottest markets take a breather. That's often your window to buy. Now, Toronto. One of the fastest growing metro populations in North America. Home prices climbed from $739,000 to over $1.1 million between 2016 and 2023. But rising interest rates and tighter mortgage stress tests slowed things down. Sales volumes dropped nearly 12% in early 2025. Still, with tight supply and strong immigration, Toronto's fundamentals stay solid. Miami's next. People flocked there for sunshine and low taxes. Median home price soared about 50% from 2020 to 2023. But hurricane insurance premiums doubled in 2 years, cooling the market in some neighborhoods. So, always factor in environmental and insurance risks for coastal properties. Here's your risk radar. Markets can change faster than your favorite streaming service's subscription price. Watch out for economic downturns, policy shifts like rent control or foreign buyer bans, and overbuilding. Too much supply can crush prices. Pro tip: diversify. Spread your properties across different cities or asset types. Think Dallas condo, Montreal duplex, Phoenix short-term rental. Bottom line, don't just look at the house, look at the whole neighborhood, city, and economy around it. So, track jobs and population, follow infrastructure projects, watch policy shifts, learn from cycles, and spread your risk. Now, are you analyzing regional market dynamics or just picking the cutest house on Zillow? Drop your dream investment city in the comments, smash that like button, and subscribe for the next market deep dive. Until then, may your cash flow be strong and your vacancies be short.